Well, yesterday afternoon, we learned that the Fed is afraid. Again, I think it is very obvious. You don't do a double cut 50 unless the Fed is afraid. Now, for the big question, for the money making question, what is the Fed afraid of? Is the Fed afraid that unemployment is going to shoot up from 4.2 to 4.4, as the dot plot says? Is the Fed truly afraid that unemployment will take the elevator up and blow right past 4.4 and end at 5 or 5.5? Maybe. Is the Fed afraid of banking crisis 2.0? In the last couple of weeks, we've learned more and more about commercial real estate taking significant haircuts. Excuse me. Has the extend and pretend run its course? And the Fed is trying to help the banks recognize losses without going insolvent? Is the Fed afraid of the election? Is the Fed afraid of Trump winning? Is the Fed afraid of Kamala Harris winning? Is the Fed afraid of consumers simply retreating and stop participating in the economy? Is the Fed afraid of the US dollar being too strong? Frankly, folks, there is a laundry list of reasons the Fed might be afraid. And frankly, it could be a combination of things. But I think it is really important to understand. I think it's really important to understand just how out of the ordinary yesterday was. Yes, I understand that Jerome Powell did his best to talk up the economy. Frankly, it kind of strikes me as odd. Excuse me, let me get a drink. It kind of strikes me as odd. Let me play out with you the data dependence. Current projections for the quarter is GDP above trend at 3%. The current unemployment rate, most recently reported, was 4.2. Inflation is still a problem in greater than 2.5. The stock market is at all-time highs. And this is the economic backdrop where the Fed cuts 50. It doesn't make sense on the surface. And that's why for the last several weeks, I've been highlighting, is the Fed concerned or afraid? Because whether we like it or not, the Fed could say they're data dependent all they want, but you and I both know, I frankly should say, you and I both hope that they are smarter than that. They realize that the economic metrics they are given each day, each week, each month are their rear view mirror looking backwards. I believe the Fed has been playing possum, and the Fed has been doing a lot more of looking out the windshield. The windshield is this big. The rear view mirror is this big. And I believe what the Fed did yesterday is they flinched. They went, ooh, that's going to be a problem. Back to this being a historic move. Did you know until yesterday, there was only 2 times in history where the Fed started its rate cutting cycle with a 50? Most rate cutting cycles start with a quarter. Again, you can go back, look at history, go to Google, type it in, do whatever you'd like. There has only been 2 times until yesterday, so yesterday marks the 3rd time, where the Fed initiated their rate cutting cycle with a 50. Now, if you go back and look at when those 2 times were, once, the Great Recession. You know what's really odd about yesterday, September 18th? I want to make sure I get this quote correct. September 18th 2023. September 18th, 2007. Folks, they often say that the economy rhymes, right, with history. Well, folks, nailed it. 2007, September 18th, the Fed cuts 50 basis points. In 2018, the headline said, in a bold move, in a surprising move, the Fed cuts 50. Now, if you know anything about that environment, that did not end well. We were already in or soon to be in a nasty, nasty recession. So again, I don't take the Fed at their word. And frankly, I don't take people at their word. One of the things that I think is very important is to, yes, people say a lot of things, but what are they actually doing? I think the Fed and Powell in front of the microphone did his best song and dance to say, don't worry, everything is okay. Again, I think everything is okay if you look in the rearview mirror. Again, what I think Powell did yesterday is when, oh no, we are looking out the windshield and what we see ahead of us is a problem. So next thing we learned, nailed it. We've been doing really, really well. First off, I was absolutely wrong, but I've already admitted this. They cut yesterday. I had hoped they didn't cut till November, but they did cut yesterday. I've admitted that mistake the last several weeks. But I warned you that if the Fed cut, that rates would go up. Mortgage rates would go up. And they did. They got worse yesterday. Here's the problem. We talked about this with Matt, the mortgage guy, right? We did an instant reaction after the Fed announcement. We did a reaction 4 minutes after we learned the Fed was cutting 50. And what we talked about in that is something I want you to be very careful of. I got 17 emails yesterday from folks in the mortgage industry. These had to be templates or mass email or whatever. But if I got 17 emails saying, hey, the Fed cut rates, time to refi, time to do a HELOC, time to do this, time to do that. Imagine how many folks out there are reading the headlines, the Fed cut rates. They are expecting rates to fall, but you and I both know rates got worse yesterday. This is the refi boom. This will make the refi boom go bananas, in my opinion. The average public is not paying attention. My biggest fear for this environment is there are current homeowners and asset owners who are not sophisticated. They are going to get talked into a refinance. They're going to get talked into a HELOC. That is not financially good for them. Please do me a favor and work with a professional who is willing to tell you this is a bad idea. There are a lot of call centers who have scripts and just an army of commission-based salespersons that don't care about you. These sharks know how to sell. They know how to manipulate, and they know how to make you sign on the dotted line. Please be careful. Please have somebody review it that's willing to tell you no. So a couple of other things, again, I've noted. This is just wild to think about. Jerome Powell, the housing market. Jerome Powell said this in front of the microphone yesterday. Jerome Powell, lower rates will bring sellers and buyers back to the housing market. Well, if you've been following my channel for any length of time, you know that that statement is technically correct and also full of blank. Why do I say that? Because I believe, and I think if you gave Jerome Powell true serum, he would believe, the rate at which marginal demand comes back to the market is significantly higher than marginal supply. What do I mean by that? Well, of course, I believe if you took rates, for example, to 5.5% like that, you would get a wave of marginal demand and you would probably get a trickle of marginal supply. Of course, the Crash Bros are out in force, which again, I am so happy none of you are watching Yes, the top 15 channels of my channel. Don't watch those idiots, morons. You do great work. You're definitely getting more and more information, which I appreciate. Lower rates is not going. I just don't get it. How can higher rates crash housing and lower rates crash housing? That doesn't make sense to me. But anyways, I digress. Here's the deal. I believe at a minimum, we've got to get to 4.99 to unlock marginal supply. I actually believe that 5.5% is absolutely the worst interest rate because the amount of marginal demand that comes back and the trickle of supply is completely unbalanced. And we could see a housing market come spring that mirrors or rhymes with the craziness of 2022. And frankly, I don't want that. I don't want us waiving appraisals. I don't want us waiving inspections. You know the drill. Be good investors. I think if you really want to get a wave of supply, we got to go to 4.99. So since yesterday, the market is already pricing in a 50, another 50 for November. Yes, folks, I think it's Wednesday, the day after the election. The Fed is already, the market is already pricing in a 50. I think the Fed has done a decent job saying, hey, here's your 50. From here on out, we're going to give you quarters. I don't believe the Fed. I think the Fed is clearly looking out the windshield. I don't know if it's the economy. I don't know if it's the job market. I don't know if it's banking crisis. I don't know if it's the election. I don't know if it's the consumer, but something spooked the Fed to cut 50 yesterday, and you and I have to figure that out. So next up, today's the day for existing home sales, and I'm going to celebrate. We got it right again. You can go back 2 or 3 months ago, and I warned everybody in the real estate industry that unfortunately we were going to take out the cycle low. The cycle low for existing home sales had been 3.88 million. I told you we were going to break below that. And I told you it would happen in the next 2 or 3 months. Well, it happened this morning. The reason I was a little bit late to start this session at 7 is I wanted to get the existing home sales numbers that came out at 7 a.m. So at this point, I just have the highest of level. I will look into the details and give you more later. But existing home sales last month was 3.96. The experts were telling you it would be 3.9. On Sunday, I told you we were going lower, and I think I said we are going to go to 3.85 or 3.86. You can go back and watch Sunday's episode to confirm that. I might have said 3.83, but anyways, we were right again. We now have a cycle low. For folks in the real estate industry, I do have great news. I think that's the bottom. I think the August sales of 3.86 will prove to be the bottom. Now, please understand, I am not talking about some V-shaped recovery where we're suddenly going to go back to 5, 6, 7 million. That's not happening, not happening, not happening. But you can understand that 3.86 is the bottom. I don't think we get above 4.2 in 2024 or 2025. But again, you can take some solace in understanding that we have hit bottom in transactions. Again, 3.86. Again, the economy is strong, but here is a supersized rate cut. I don't know. It just doesn't feel right. It just doesn't feel right. Let's talk about the dot plot. Again, what does the Fed see in the future? So again, this is what they now expect in 2024. They expect GDP to be 2%. They expect unemployment to be 4.4%. Again, we are sitting today at 4.2. PCE, they expect headline to be 2.3 and PCE core to be 2.6. And then finally, they expect rates to end the year at roughly 4.4. What does that mean? Again, in the Fed's dot plot, they are telling us we have 2 more rate cuts coming. The market is telling us we have 3. The market is telling us we got 50 in November and 25 in December. I think what is most interesting is what changed in their expectation from 3 months ago. They expect GDP to be slightly down by 0.1%. They expect unemployment to be up 0.4. Again, last 90 days ago, they thought the peak of unemployment would be 4%. It currently is sitting at 4.2. They thought inflation would be a bigger problem. Earlier, they thought 2.6. Now they think 2.3. So they clearly feel they are beating the inflation battle. And again, they thought rates would end the year at 5.1, maybe one rate cut. And now they expect to be at 4.4 or 5 rate cuts. So again, or 4 rate cuts, 4 rate cuts. So again, it is very interesting to look at the Fed expectations. One thing I should highlight about this Fed rate decision, it was not unanimous. Yes, folks, Michelle Bowman was the only Fed president to stand up and say an oversized rate cut was not warranted. Shout out for Michelle Bowman to staying true to her beliefs. I'm sure that meeting had a lot of pressure on her because I strongly believe Powell wanted to go to market with the message of unanimous. This was the first non-unanimous decision in several years. Congrats to Michelle Bowman. Next up, let's talk about unemployment. Again, every Thursday, we get the weekly unemployment claims, and boy, they're saying the job market is strong. What do I mean? Remember last week, the unemployment rate or the unemployment claims was roughly 231,000. Expectations for this month or this week was 230,000. Basically more sideways action. Folks, we went down quite significantly. We went down to 219,000. So again, I know there's a lot of talk, a lot of doom about weekly unemployment claims. All I could say, not yet. Not yet. And again, we went out and gave a super-sized rate cut when weekly unemployment claims was 219. I want to do a quick check of the market. I'm just pulling it up on my phone. Hopefully it behaves this morning. Because when I looked earlier, the futures were up big. Oh, wow. Look at that. The Dow's up, at least as of right now, 7:20 a.m. Pacific, up 440. S&P's up 92. NASDAQ, oh my gosh, the NASDAQ's up 440. What are bonds? Oh my good rates. I told you. Rates are up big today. Mortgage rates are getting worse. Folks, the Fed cut 50 and mortgage rates got worse. Man, I'm good at this stuff. And then for those of you in the Bitcoin or crypto world, congratulations. You just got a $3,000 bump or up 5% to 63. It's really interesting to kind of look at all of this. Again, when I look at the market, risk on assets, this is clearly a risk on. Crypto up, NASDAQ up, bonds worse, right? Risk on. Do we have what Joseph Wang called the crash up? We really could. I'm telling you that my biggest fear is we have just set ourselves up to repeat 1981. That makes me sick to my stomach. It was my belief if we held on another month, another 2 months, that we could have killed inflation. I understand the whole, hey, we're too restrictive, this, that, banking. I get it. But we were so close to killing this monster only to give up. And my fear is this monster comes back. Go back and look at the charts. We have the 54-year spreadsheet on my website, One Rental at a Time. It's there for you. And realize that the second bout of inflation, frankly, is much, much worse. Much, much worse. I lived through it. I saw what happened to my family, multiple layoffs. I saw gas lines. I saw all of it. It is not good. Now, again, nothing is guaranteed. We should not hope for or wish for a second bout of inflation. That would not be good for our economy. would not be good for the middle class, which again, we are trying to strengthen and grow. But it is a fear of mine. And then lastly, folks, I want to congratulate folks for joining school. We got 2 more folks joining school yesterday, participated in the wonderful discussion with Dion, Matt, and I. Again, you can find that video in school. Just go to the classroom section. There is a thumbnail that says special guest. That special guest thumbnail has dozens and dozens of interviews with millionaires that you have to watch. You can only find most of those in school. So I want to congratulate Odif and Cody. Hopefully I didn't mispronounce that first one too badly. Folks, it is my belief, it is my want to be the #1 real estate school on school. Right now we are sitting at about number 700 all in. We are the #5 real estate school. I've looked at the other schools. They have nothing on us. Value, weekly discussions, replays, the community. It is my belief that we need another 50 to 100 students in there collaborating, asking questions, participating in the 2 accountability groups. And we will quickly shoot up the ranks, and one rental at a time will take its place atop the heap. We will be the #1 real estate school on school very, very soon. Remember, folks, on Sunday, you're going to get the opportunity to interact with Simon, the uneducated economist. You will not want to miss that, only on school. And on Monday, I'm still trying to line up Taylor from Life Goal Investments to talk about his 10 years on Wall Street, to talk about a balanced portfolio, to talk about the JP Morgan's call for a flat decade in the stock market. You want to be a part of this. I know it's important. All right, folks, take care. Have a wonderful day. Again, the Fed is scared, but scared of what? That is what I'm trying to figure out. Like, subscribe, comment, become part of the party. Don't forget to check out Bigger Pockets Money. They were nice enough to interview me. Mindy was a wonderful host, and that is a wonderful discussion. All right, folks, take care. Later.